we've been accounting for sales and asking the important questions. Will cash be affected? Will profit be affected? Cash will be affected if we have a receipt in the case of sales. And so far as purchases go, cash will be affected if there is a payment. So let's focus on that bit. This is the reconciliation that we previously had for accounting for sales. We were reconciling profit with cash flows. So some principles will be the same and some will be different. Some detail will be different when we start accounting for purchases. Purchases might be things we're going to sell, so goods for resale. They might be, or raw materials to incorporate. They might be services. So let's just remove all these details. Let's have the same starting point. First thing we won't need it just yet, so let's add it in a moment. We won't have any receipts probably here, but we are likely to have payments. And let's just explicitly say minus payments. And this means we might end up with an inflow, or we might have an outflow for the period. So if only got payments, we're actually going to have outflows. The principle is the same, and we just got negative numbers. So going on to the income statement as well as income, we might have expenditure or spending or costs. Let's call them costs, expenses, which might result in a profit or loss period. Let's anticipate this part. Let's put the payables in at this point. So if we make a sale on credit, we get a receivable. If we make a purchase on credit, we can end up with a payable. So let's put the payable liability, negative item, into our balance sheet. And this reconciliation, if payables increase, our cash will tend to be greater. If there's an increase in payables, cash will be more. If there's a reduction in payables, cash will tend to be less than we'd otherwise have expected. Reduction in payables. So that will work, and we'll see why it works with some examples. So first of all, let's have a cash purchase. In other words, we need something, let's say it's a service, and we pay for it straight away, and let's say that costs us 5, our cash will go down. It's a payment of 5. So closing cash is 5 because we spent 5 of it on expenses this period. And if we spend 5 on things we need or use this period, then we recognize it as a cost. So for a cash purchase, cash goes down, net assets go down, and we incur a loss. So profits go down, or we get a loss, assuming nothing else was going on. And then reconciling between the profit or loss, which is a loss, and the cash inflow or outflow. There's cash outflow of 5, and there's a loss of 5, and there aren't any reconciling items. Okay, let us make a credit purchase. So we get the benefit of, let's say this is for 2. We're getting the benefit of a service, but we don't have to pay for it later, until later. So we're going to have a loss of 2. We've got an expense, no payments or receipts, but an increase in our payable. So we've got a new liability for 2. We're going to have to pay in the future. Net assets went down because we had an expense in the period. We have a new liability. We've got no corresponding asset, no receipt or payment in the period. The profit or loss for the period was a loss of 2, but there wasn't any change in the cash. We've got an increase in the payables. So payables started at none. They went to 2 of a liability. We've got 2 in our bank account that will be in the supplier's bank account, but just for now it's in ours and not theirs. So our cash is greater, 5, still 5 than we would expect, having incurred a cost. And the reason is we're being given time to pay. Let's say we pay now, pay the payable, also known as a creditor. So let's say we pay them 1, then our cash goes down by 1, our creditor goes down by 1. So we've transformed a liability, the payable, to a reduction in our cash by paying them off. We've reduced our cash, and that's neither an income nor an expense. And let's finish that off in the next segment.